Morning or good afternoon, depending on which side of the country you're joining us on. Thank you for joining us today. We're super excited about a new series or an additional to our webinar series here. We've historically done ALM 201, 202, 101, 102, now 301. So I love it. We're adding on, and it's exciting to have us all here. All right, the presentation started at 2 here, so we're kicking off right now. Heather, I'm Charlie McQueen, President McQueen Financial Advisors. I'm fortunate here that I've got a couple incredible people. Heather, who runs one of our core business lines, our ALM, interest rate risk, and all sorts of great things, including CECL. Heather, thank you for joining me here.
Thanks for having me. Looking forward to the conversation.
Yeah. Heather runs a third of our business model. The other two are investment advisory services and our valuation area. So we're super excited to have Heather here, one of our leaders. Thank you very much. Joining Heather today is Bill Verrett. We're excited to have Bill here also. Bill is one of our senior advisors, and I'm excited. Bill's got a great history behind him, and he does live in the western part of the country, but he's from the south, and so we're going to hear some of his great southern terms. So thank you, Bill, for joining us today.
Yeah, thank you, Charlie. So hopefully I don't talk too funny for some folks and you guys can understand what I'm saying.
Ah, gosh, I love it, dude. It's not funny, it's colorful. So thank you very much.
Okay.
All right, so today these two are going to educate everyone here on all sorts of fun stuff. And ALM and ALM levels, we're actually getting to a more advanced level, which I'm really excited about that. As we go through the webinar today, it is recorded and it will be available on our YouTube channel. If you'd like a copy of it, please reach out to your advisor and give him feedback, him or her feedback about the presentation, and also ask for a copy of it. Or you can go to our website. Super excited about our redesigned website here in the past 6 months or so. And all of our webinars are there. You can go in and check them out and the learning series that we've put together. So a lot of work's gone into that for our team. So thank you all for doing that. Also along the way, if you have a question, there is a Q&A button usually on the bottom of your screen. If you move your mouse, it'll pop up. Use that, not the chat button. It's much easier that we'll see the Q&A button. But click on that, put your question in there. It'll get answered along the way or at the end, depending on the question. So really, really super excited about this. So with no further ado, Heather, you can flip to the next page. And I want to hand this off to Heather, who's going to lead this, and with her partner, Bill. Thank you, guys, and some great information, Heather. All yours.
Thank you, Charlie, and thank you everybody for attending today. We're very excited for the wrap up of this ALM series. In first quarter of the year, we did present the ALM 101, which is asset liability management, and it's kind of the introduction to the concept of what ALM is. And then into second quarter, we got into our 201, which was an overview of the assumptions. And we're going to recap both of those themes today, as both of those pieces are very important to understand and bring into what the 301 is going to look like. And as we get into third quarter, this is, what we refer to also known as budgeting season. So as we do this, we want to be able to utilize the ALM tools to help with decision making as we go into that. So today we're going to dive a little further into themes such as liquidity. Liquidity is a big concern in our market right now. So we want to make sure that we are talking about that and seeing how that's impacting our balance sheet. And delinquency is starting to pick up, kind of getting to these levels outside of post-pandemic. So talking a little bit more about what this means for us and how we need to be able to approach it. And then the last piece, the most important, is profitability. And at the end, we'll open this up to some questions for you to be able to reach out for. As Charlie had mentioned, using that Q&A button is a perfect location to put those questions throughout the webinar, and we will touch on those at the end. So going on to our next slide here. Bill, why don't you go ahead and kind of give us a little bit of a recap of what we discussed in ALM 101?
Sure. Thanks, Heather. So going back to a recap of 101, which was done earlier this year with our colleague, Jim Matthews and Heather, we discussed what is ALM, why and how we perform ALM analysis, with a focus on net interest income and net economic value of equity. So those are the kind of things that we started out with in the ALM presentation for 101. And then Heather's going to take it from here and explain a little bit more details.
Right. So the very first thing that we touch on is what is ALM? ALM is an acronym, not quite sure what that means. And what that refers to is asset liability management. And as you can see here, this is the art of managing the mix of volume and interest rate sensitivity, which is looking at our net interest income, and sources and uses of funds for the purposes of controlling interest rate risk and providing a constant positive net interest margin. That's very important as we are in the world of margin. This is what we do. So when we look at ALM, we are looking at, as I refer to as the teeter-totter. It's that balance between our assets and liabilities. And there's definitely some activities that are going on right now in the market that is kind of tipping that scale a little bit. So we need to make sure that we're well balanced and that our risk position is in a position where we can handle what those plans may look like for the future. And today we're really going to kind of use the ALM tools that we have here and taking that knowledge to help us be able to have decision making for planning for the year to come. So, Bill,
Yes.
how and why do we do ALM?
Yeah, so the why is you constantly access your mix on the balance sheet to see how you withstand the different rate environments. As Heather was showing on a previous slide, that teeter-totter, we always want to be balancing that out. So, we as less sensitive as possible and with the highest possibility of profitability and margin. So that's the why. And the how is, we take a snapshot of your current balance sheet. We run it through our model with the assumptions that we have with no growth, right? And then if we want to see growth or changes in the balance sheets, we'll run simulations with what ifs and make some changes to those. So that's kind of the why and how we do it. And then, the next page that we have here, we can show you a little bit more detail about the net interest income and expenses. We're really looking this over the next 12-month horizon when we're looking at this. And then we run at interest rate shocks over various scenarios. Here at McQueen, we run it both on a gradual basis and a shock basis. And the shock basis, is there for our regulatory reporting and things that we need to look at and to see if we have these shock scenarios that occur. Recently, the Fed has been raising rates over, the last 18 months over 500 basis points. So that's quite a bit. It's not actually a shock, but it has been going up quite a bit. And then the level of repricing will depend on our mix, whether, we're asset sensitive or liability sensitive. So that'll have an impact on what our rate shocks will look like.
Yeah, and that's really important as we get into, what this profitability could look like. And that's one of the very first pieces, as Bill has touched on, is the impact to our income. And then the second major moving part to this is the impact to our value or our NEV. You heard this referred to as NEV. This is net economic value of equity. Now, one piece I want everyone to kind of keep in the back of their mind is the impact to NEV and sensitivity with longer duration products versus shorter duration products. And we're going to talk a lot about that today and what that could look like for a balance sheet right now. And this is mainly because the way the market is and the position of where rates are in comparison to what rates are on our balance sheet, we do kind of have a heightened level of NEV sensitivity. So we have to keep that in mind when we're planning for the future. And you can see a great example here on this page where when we look at longer products such as 30-year mortgages, this is going to hold much more sensitivity as rates go up because they're locked in on the balance sheet for a longer period of time, staying at those lower rates. And you can see this green line represents what that devaluation could look like. So this is really important pieces to understand the difference between overnight pieces that reprice with the market right away. You can see our overnight funds is this gray line that's just flat. There's really no changes there versus a 30-year mortgage has a lot more sensitivity. So these are the things that we need to monitor and watch as we're testing the model. And then as we go to the liability side, the same concept here, but it is the opposite. Whatever that value looks like is being deducted from our assets, leaving the remaining equity position. So the more reduction of liabilities, the more value that holds because we have more assets left over more equity left over at the end of the day. So these are definitely concepts that we're going to use today to help make some decisions.
Yeah, and also when we go to the recap of 201, we talked about the model assumptions, and model assumptions really have a big impact on the results that we have and both the sensitivity. The biggest ones are prepayment speeds and non-maturity deposit retention in terms, but also betas or rate sensitivity factors or repricing and replacement rates, which means the rates that are coming back on for the static balance sheet that we're running. And the big thing about this is, the more accurate the assumptions are, the more accurate the results are going to be. So we want to look at this. We also want to do simulations because, we may not be exactly right. And so what is our potential exposure if we go one way or the other off of the initial assumptions that we have? And we want to view this as the impact to margin and spread because a lot of that drives our profitability.
Yeah. A somewhat important piece as we're going into this higher interest rate market right now and planning for that future.
Yeah, so first talking about the prepayment speeds, CPR, so some people call it conditional prepayment rates or constant prepayment rates. But really what that is, that's the extra principal payments received over and above the contractual scheduled principal payments. So if people are making additional payments, but normally it is the prepayment or refinance activity that someone may, occur and refinance that loan. When you look at these tables and charts, which you'll see here, lower rates, as an example, in 2020 creates faster prepay speeds, right? And we have both the 30 and 15-year fix as examples. When you have higher rates and slowest prepay speeds, which you're seeing 2022 and also 2023, you have, much slower prepay speeds and extension in your portfolio.
And Bill, this is a really good point when looking at the duration of our cash flow. The prepay speeds has really lengthened out our cash flow because that incentive to refinance is just really not there. So one activity we're seeing quite a bit is kind of a flooring of speeds where they just aren't picking up, and the length of that duration is really lengthening that out, which is causing some of that extra need pressure or value because it's just not repricing at those higher rates nearly as quickly. And like you said,
Exactly.
that's continued into this year significantly.
Yeah, so you're having that extension on those assets and more sensitivity is created.
Yeah. And this goes hand in hand with Neve and talking about that position, especially as we talk about non-maturity deposits. Non-maturity deposits, represent a stable, low cost of funding source. This is checking accounts and savings accounts and IRAs and money markets. These are products that can come and go very quickly and are very liquid. This is one of the pieces that's really impacting liquidity right now, is seeing a lot of deposits leaving the institutions. And these deposits hold a large amount of value as alternative funding sources are inherently more expensive. And we're actually going to be looking at some of those things today and where those options are as we are concerned about long-term profitability. And what we're having to pay on our deposits is really driving what that's going to look like at the end of the day for us. So we're really going to talk more and more about how these things are impacting us today. But that retention term is really a big concern as liquidity is just not in the most favorable position right now. Looking at things such as this is as we get into these non-maturity deposits, retention does change over time. Different rate environments is going to show different activity. So we'd like to look over time of how these things are changing and what does this activity look like. Right now, liquidity is a big concern, especially in the deposits, as we saw a lot of stimulus money come in during the pandemic, and a lot of that money has actually left. And looking at this study that you're seeing on this page here is looking at all of our standard types of products that you would see in a non-maturity deposit pooling. And as we look through these, we can see that we had a big influx when the pandemic started and all that stimulus money came in, but maybe certain product types didn't have a lot of that funding sitting in these types of products, such as money markets. And you see it was very, very small growth where we're seeing a lot more of that going into our savings and checking as expected. So as time goes on and we got through that pandemic, that overall was a very large reduction in money markets. This is what we refer to more as a rate shopper versus our sticky. The sticky deposits are more of these savings and checkings versus rate shopping products, which are going to be more expensive. We're going to have to price these a little bit higher. We're going to have to respond to the market a little bit faster and to see what that long-term impact looks like for us. And we're going to dive a little further into this in just a few minutes as we get into that 301. But this is definitely a piece to keep in the back of our minds as we're planning for the future.
Yes, and another assumption that's factored into the model is we'll call it betas or rate sensitivity. And that's the response to changing rates for a 100 basis point move in the Fed fund. So when the Fed, raises rates, it's usually been 25 recently and 75 basis points before that. But what percentage of that rate increase do the products respond to that Fed increase or change in rate? Both on the asset and liability side, factors to consider is the type of product that it is it fixed or variable, and how does it move in relation to that? And do those products have any caps and floors or periodic caps? So all that's taken into consideration when we run it through our ALM model, and that could impact on the sensitivity that is seen in the accounts and the sensitivity overall in the accounts. One thing we've been talking a lot about with clients is pricing and repricing, right? So as rates have moved up, that beta that I was just talking about is how fast did you move up your loan pricing, and also how fast did you move up your liability pricing, deposits. One thing that we talk about here at McQueen and have been having many discussions with our clients about that is, ground up pricing and build up method, right? So here we're looking at the risk-free U.S. Treasury rate at 4.5%. We're putting a CECL allowance of 1% and an additional credit tier spread for the type of loan that we're looking at. There's also a servicing cost and also a desired ROA or ROE that we're looking for. So when we put those together, you can see that that comes up to 8% rate that we would need to hit our target. So what type of loan can we generate at 8% to do that? And so with this is kind of a build-up methodology that we use. And we think it's important to look at that because depending on what that rate is and spread and margin, you can have an increase, a decrease in spread and margin, but leads to an increase, a decrease in profitability. And that is a concern going into 2024 and the end of this year.
And it's a great topic because, when we are getting into margin, we need to make sure that we're understanding and doing the right things for the asset side of the balance sheet and also planning for that increase in pressure that we're seeing in our cost of funds continuing to rise. And here's a great example of how quickly we're seeing some of these costs increase. So if we go back to our liability costs in March of 22, we were at 14 basis points. At this point in time, we had a lot of deposits. Liquidity wasn't a concern. So we didn't need to raise our rates to be able to hold on to these. But that has changed over time. And you can see this very large increase very quickly on what those expenses looks like. So that's why it's so important to follow a proper pricing structure when looking at lending as Bill was just discussing, because of the spread between our asset yields and what our liability costs are going to look like. So going into the future, we need to make sure that we are maximizing what we can do today.
Right. So a recap of 101 and 102, we need, folks to understand ALM is not a regulatory burden, right? It's a very valuable tool for decision making. And I think it's going to become more valuable and more important as the amount of core deposits that credit unions have is more likely to become less of the entire liability side of the balance sheet and also the core deposit. So you are going to have more term accounts and you're going to have potentially more non-member accounts. And we'll also talk about borrowings, right? So we'll talk about that in some coming slides, but getting the assumptions right is going to give us better results. So we'll try to do that. We'll do simulations to what if we can't, hit the assumptions right, at least we have a variety of different options to look at. And it allows us to be more proactive than reactive. So as we go into the budget season, we want to look at a variety of different simulations to come up with what we think is going to be the base case in the most likely scenario. But we can also budget and also do simulations on a worst case or if things don't go our way. And I definitely suggest that people run various simulations because we're in a volatile market environment the last few years, as we know, both the deposits coming in and flowing back out. So I think as many simulations as we can to prepare for those potential opportunities is going to be helpful in planning.
Oh, absolutely. And that's the nice part with ALM, is especially when we look at net interest income, that's a 12-month forward projection. That's our crystal ball. That's our future. Where are we going with this? What's going to happen if we don't do anything over the next 12 months? We have to start that as our base case. But like Bill had mentioned, doing simulations, trying to look into the future. If we did this, if we did that, is this the right thing for our balance sheet? This is how let's go and use these tools to help us make those decisions. Is really going to give us a good picture of what this could look like in the coming year. So
Totally
as
agree.
yeah, so important, especially, regulatory guidance requires us to do a base case or a flat static balance sheet, no changes. And we know that's not the real world. That's not what's going on in the market right now. So, utilizing those simulations is just such a powerful tool we could use. So today we're going to show some examples of what this could look like. We're going to leverage our ALM for decision making. We're going to focus in on our biggest concerns that are on the radar today, which is liquidity. And we'll talk a lot about deposits and borrowings and what our options may look like, what lending could look like, and then obviously talking about our concerns with increasing delinquency and making sure that we're doing the right things for long-term profitability. So as we go into focusing on one of the biggest things right now, which is, as we had mentioned just a little bit earlier in this webinar, is talking about our non-maturity deposit decay. This is a big concern on many balance sheets. And as we had looked at, we had seen that there wasn't a lot of growth of products such as this. And again, this is more that rate shopper type of product. They're looking for those higher rates, and that money is usually fairly liquid and moves around. So when you're in a market such as this, you're going to see some fast movement there. And that's exactly what we experienced recently for a product such as money markets. So when these things are going on, this is when we have to go back to the accurate assumptions, gives us accurate output to be able to make those decisions. So maybe we need to review what is our terms that we're using in non-maturities. We had talked earlier about that assumption and the impact to NEV. The longer these deposits stay with us, the more value that holds. Otherwise, we have to go elsewhere for more expensive types of deposits. So if that's the case, let's look at the retention terms we're utilizing for these products and make sure that that's still appropriate for today. Things change over time. For about 10 years, deposit retention wasn't an issue. Deposits didn't really go anywhere. Today is a very different scenario. Bill, I know we've had a lot of conversations going back and forth with many institutions. I mean, liquidity is still a big concern. Deposits are still hard to come by at this point, correct?
Definitely. I think, it's not only the competition at the local level with other credit unions and banks, but what we're hearing and seeing is now the brokerage firms are actively, soliciting for those funds, your Fidelities, your Edward Jones, and trying to get those funds and saying, hey, look, move your money from the bank or credit union at 2 or 3% and come into a money market fund at 5+%, right? You got this big, so credit unions are not only competing against other credit unions and banks, but they're also competing against brokerages. And then basically that's some of the government funds that you have at 5+%. And
Yeah.
the concern I do have, and I think members need to think about, is that that's probably going to last longer than originally anticipated, right? So they're holding those rates longer, higher for longer, which puts more pressure on, financial institutions, because as more people potentially move their money out of the banks and credit unions into brokerages, they may have water cooler talk or picnics and things like that, talking to their family and friends, and that continues until finally, the Fed starts reducing rates, and we don't have as big a spread between deposit institutions and those government money market funds.
Yeah. Yeah, it makes it harder and harder to hold on to these. So when that occurs, we have to make sure the assumptions in the model are correct so that we can know where our risk position is so we can make the right decisions. And here's a great example of this, where if we look at these money market products and know, could we have slowed this? This did run out pretty quick, significantly different than the rest of our deposit types. But maybe this was one of those items where a lot of those funds just shifted into term deposits. Maybe we were doing term deposit specials and we just saw some migration shift from one to the next. That's not helping our liquidity position. That's just increasing our cost of funds. So if things of that sort are occurring, we need to stay ahead of our assumptions in the model. And this seems to be a focus point of examiners today. So here at McQueen, we've been spending a lot of time talking about our retention on deposits, making sure our assumptions make sense for us. So in this example, maybe we go in and we shorten our duration on these money markets because we don't believe that this is going to turn around anytime soon. And these are going to be more liquid liquid and they're going to leave the institution faster. So let's go and test what it would look like if we did reduce those terms, because we want to be reasonable and appropriate with our assumptions. And we can recognize already that these are types of products that we may have to shorten that duration because things have changed. So as an example exercise is going in and let's change a duration on a non-maturity product that we've identified is going to have a lower retention. So if that's the case, that's going to be a straight impact to our NEV position, this net economic value of equity. And in this exercise, you can see that we began with somewhat close to policy. We have policy limits saying that that balance of our risk position needs to stay within 10, 20, 30% for every 100 basis points. And if we were to shorten that duration a little bit, you can see we're starting to push towards that edge of our policy. So this needs to be a part of our conversation of what do we need to do on our balance sheet to ensure that we're not going to tip that scale even further and be outside of policy, doing the right things for our balance sheet. Every balance sheet looks unique. Every balance sheet has its own position. So making sure that we're looking at what is impacting us. And so in this exercise, you can see that if we were to shorten this duration, that we're getting too close to that policy limit. So what does that tell us? This tells us that if we were to look at lending and looking at these other options, that asset side of the balance sheet probably needs to be a little bit on the shorter end. It can't continue to add duration. So with that being said, that's an item that we're going to recognize and we're going to tuck in our back pocket when we're looking at these other decisions on what our plan is going to be in the future. So Bill, tell us a little bit more on the term deposit and borrowing side. We know non-maturity deposits are kind of hard to come by right now, which pushes the focus over to the term side.
Right, Heather, as you may know, and many of our clients are currently running term deposit promo specials, a variety of CD specials to try to attract and bring in more money. As you were mentioning, a lot of times it's just going from non-maturity deposits into term deposits, and we're actually not getting any additional funds. So that is a challenge that some folks are having. And, with that, it does take some time for it to come in, and the cost could be very expensive. So one of the alternatives we want to bring up, which also can be expensive, I don't want to emphasize that it's not, but it can be cheaper in certain situations. And so what we have here is, a look at borrowings and what those terms might look like compared to deposits. And just so you know what these rates are down here, these rates are from the reports that we put out with McQueen, the daily and weekly reports on deposit CD costs. These are the highest ones out there in the marketplace, which you may be competing against, right? So these may be institutions in your marketplace and or online, right? So these are some of the highest rates out there. And then we have FHLB borrowings from Indianapolis FHLB. So what you'll see is actually FHLB could be lower than those high cost deposits that are out there. So this is something that you do have to look into and see how that compares. The other thing I would suggest, which is usually even more higher than both of these, is your corporate, right? And then we have those other bank government type facilities that might be an option also for you. So I take a look at all these and do a comparison and maybe have a spreadsheet that shows you what those are. And again, you're getting this information from us through McQueen, through our weekly report that's coming out.
Being able to compare all of our possible options, so that helps us make the proper decisions going forward. And so as we got through the deposit side and kind of see some of those options and kind of where we stand, now we need to get on to the lending side of things. We know we have our investment portfolio and our loans, which is our interest sensitive assets. So when we're looking at these moving parts, we need to make sure that we are recognizing where our opportunities are. So when looking at lending, some of the loans that we're seeing quite a bit for at least demand is unsecured. With inflation and overhead being more and more expensive, we are seeing a lot more unsecured demand, lines of credit, things of that sort. So we know that there is definitely, some drive there to be able to lend and to fund. The other options here is auto loans. Auto loans have definitely picked back up a bit. We had some supply chain issues there for quite a while. Things seem to be more level set today. So we do see continued demand on lending when it comes to autos, both direct and indirects. We see a mix of those types of products on nearly every balance sheet. So there's definitely some great opportunity there. And then when we get into the more mortgage side or real estate side of things, because of the number of loans that were put on the books in 21 and 22 at much lower rates, there's not as much demand on those longer term products such as conventional mortgages. So as a lot of these homes are sitting locked in at 2 and 3%, we're not seeing that turnover or that demand for moving or refinancing. But there's a lot of equity that's sitting in these properties. So with that being said, we're seeing more demand when it comes to fixed home equity products and HELOCs. So looking at this as a simulation for our balance sheet, we can look at these product types and see unsecured, there is demand here. The only drawback with that is as we're looking at CECL and we're looking at activity of delinquency, a lot of the pickups of delinquency is starting to show up in unsecured revolving lines of credit, things of that sort. So when looking at some options of what we want to plan for the future, maybe we want to kind of hold off on our focus of trying to grow unsecured. Autos is definitely continuing to perform well for us, so we're comfortable there. And maybe when it comes to those fixed home equities, well, we just did a test of NEV and found that longer durations, really, we don't have a lot of room in our NEV position for that. So maybe fixed home equities isn't as big of an option, but looking at things such as HELOCs may be more of an option for us. But maybe at this time, our marketplace really isn't asking for those, knowing that rates may continue to go up. And if that's the case, that drive for HELOC may not quite be there yet. So taking these little things into consideration, what is our market offering us? What are we able to do on our balance sheet? And then once we decide on which product types we want to look at, we're going to go back to that discussion we had earlier in this, where Bill was really focusing on the pricing structure. So as we go into this next piece, let's just say we were deciding we were going to focus in on auto lending. We really think that we can grow some of these pieces. We see some demand here. It is so important to make sure we are pricing these appropriately. For a long time, we did see that we were trying to be competitive and we needed loans. So we stayed very, very low with those rates. This is the time of which we need to be pricing higher. We need to make sure that we've embedded these moving parts. CECL, as that is continuing to increase slowly and steadily, we are expecting delinquency levels to get to more of a normalized level. During the pandemic, we saw losses kind of floor out. Much of that stimulus money was used to pay off debt. So we were expecting to see a lot of losses during COVID, but that just wasn't realized. But now things are starting to turn around and go to more normalized levels. So let's monitor and watch our CECL position and make sure that what allowance that we're setting aside for these product types and incorporate that into our pricing structure as we're trying to identify what this could look like. And then obviously, depending on the credit level, that's going to vary on what that spread should look like, and servicing costs and getting into that ROA, ROE. So as we do this piece, we need to make sure that we are pricing these products appropriately. And starting with these moving parts is really going to help drive that spread and that profitability long term, making sure that we are in the right place here. So just to recap, some of the things that we've identified and what do we know from these discussions and what we just kind of walked through and made a plan for. So with that being said, we want to kind of relook at some of the stressors or some of the opportunities that our balance sheet may give us. So one of the first things that we did is looking at decay. Decay is a big concern because of liquidity. So what is our issue? Our issue right here is our money markets. Our money markets are too liquid. They are leaving the institution too quickly. So this is decaying faster. So let's utilize that ALM to run a simulation by changing that duration. And when we did that activity, what did that tell us? Well, this is a reduction in term. So let's run this through and let's look at what that NEV position went to. And what this shows us here is that we have less favorable NEV, or we're pushing closer to those policy limits. So when we go into the budgeting side of things, what do we need to plan for and what do we need to look at? And what we've identified is that we need to kind of focus more on shorter term lending. So Bill, going into our borrowing and the liability side from a cost standpoint, just kind of give us a little bit of a recap of what we were able to identify in this exercise.
So here we talked about the issue of non-maturity deposits moving on to term deposits, right? So we weren't really getting any additional funds. It wasn't helping our liquidity position. We're talking to clients. We do have clients who have promos out there, and it's just not attracting additional funding. It could be because of limited seg. It could be, the community is not available to do it. So the option becomes borrowing. And actually, what we showed you before is that borrowing pricing, depending on the term. And what's kind of interesting now, we're in an inverted curve. So borrowing a little bit longer is cheaper than borrowing shorter. So we did a simulation on looking to borrow funds, and Heather's going to go over that in a second. Also, she mentioned about delinquencies picking up in the unsecured. So that is a concern that you're having to pick up in delinquencies and potential additional CECL reserves and our charge-offs occurring in this. So we started looking at this and decided, well, let's look at auto loans. And so the auto loans is one of the scenarios that we do that, we're going to go through with you and explain it, how we came up with the simulation.
These are the steps that you want to do when looking at budgeting, going through your balance sheet. Your balance sheet is going to have its own unique opportunities, your own unique obstacles. And these are the things that we want to take our time and identify, go piece by piece and start to isolate these moving parts and making decisions based off of what's going on and utilizing the simulation tool to be able to kind of show us what some of these things could look like. So this is what the purpose of this exercise was, is identifying these few moving parts. And this is just a high level, just touching on a few items, but this can get much deeper, much faster, but definitely taking advantage of what we can do. So when we want to look at profitability, an example simulation that we ran based off of those decisions of what we just discussed is we're going to decide to borrow in order to fund lending. So one of the pieces that I talk a lot about in ALM is that teeter-totter, that balance between both sides of the balance sheet, both when it comes to risk for value and when it comes to profitability or net interest income. So when we're looking at those two things, we know on this simulation that our need position is a little too close to policy. So we need to continue to be balanced between both sides. So one part that we want to make sure that we're always keeping on our radar is cash flow. Cash flow is very important. Cash flow can vary based off of assumptions. And one of those assumptions being prepay speeds. And prepay speeds, as we had mentioned earlier, Bill, we were talking about how slower speeds lengthens out that cash flow, that added extra risk position when looking at Neve. So when we take those things into consideration, we need to understand if this is an amortizing product, meaning we're having monthly principal payments over the life of that product. And this really pertains to our lending. So when we look at this, we have to plan around not just our contractual maturity, but what does the cash flow look like? There are prepayments that do occur in these product types. So what is our weighted average life of this loan? And we need to be able to match that balance of both sides of the balance sheets based off of the life of the product. And this is a moving target over time. As we look at the cash flow off of what's going on now and these floored speeds, those durations are very long. Well, as rates start to change and rates start to come down, that incentive to refinance is going to go up. And as that incentive to go up happens, that cash flow is going to shorten when it comes to lending. So that weighted average life is going to shorten. And as that shortens, that teeter-totter is going to start to move back and forth. So these are the tools that you want to use and want to consider when looking at different product types. Again, it's not just always contractual maturity, like an example of an auto loan here. We want to look at the actual weighted average life and making sure if we need to balance both sides of the balance sheet that we're matching funding. So this is why this exercise, what we did is we honed in on auto lending. We did price these out, getting up to about an 8% mark. And we decided that, the value of cars is a little bit up and rates are very high. So with that being taken into consideration, as many consumers go in to go go borrow for an auto loan, they're more focused on their monthly cost versus they are on the rate. So a lot of times you're going to see dealerships trying to lengthen out durations just so that they can afford those products. So sometimes in autos, we start to see those durations getting longer, 7 years, 8 years, beyond that. Most times we see this somewhere around 5. For this exercise, we went with 6 years. It's something in between. We may not want to go with that longer end because of depreciation, but we want to make sure that we've got a decent term here that we think is appropriate for us. And a 3-year weighted average life is very appropriate for our balance sheet structure that we're simulating here. So we are going to match that on that teeter-totter and borrowings, and we're going to go with a 3-year fixed borrowing at a 473. We have priced our autos appropriately, taking all those pieces into consideration for losses and servicing and risk. So we're going to price that at 8%. That's going to leave us with a nice little spread here of that 327. So as we do that balance and we run that through the simulator, we can identify that our base case or current is just if rates don't change and rates are still where they are in 12 months from now, what would be that impact to net interest income? Well, that spread is showing a nice boost to this income position, increasing by 1.8%. These are the themes and the activities that we want to focus in on. What can we do to put onto our balance sheet that is going to help complement our NEEF position, what our balance sheet can handle, and what is going to be the impact to profitability long term, as we know these borrowing costs or these deposit costs are continuing to rise, but we can still get some benefit when it comes to that asset side of the balance sheet. So seeing a couple of these graphs and the impact here, Bill, it looks kind of nice when we actually look at net interest income with that kind of teeter-totter balance and that funding match. What did that do for us here?
Well, I think what we can see is on the page before, we're seeing that it did increase net interest income. And then when we look at here in the sensitivity, we're looking at the up rate shocks. It actually decreased it a little bit, just a little bit, but overall that's pretty well balanced, so that's a good outcome that we're looking for, right? The same one down, very little change in sensitivity. So we picked up net interest income and our sensitivity didn't change much. When we go down and look at NEV, same type thing, right? So the sensitivity actually declined a little bit compared to the standard report that we have. Again, so this is a good outcome. So our sensitivity actually declined a little bit by getting that balance right, and our income improved. So these are both desirable outcomes that we have. And in simulation, you may have to play with that some and see what that optimal funding mix might be and pricing. But if you use that tool and you could come up with a solution like this is kind of what you're looking for.
Yeah, and this is exactly the key to this. And this is actually one of my favorite sensitivities to see, especially on net interest income. When you're consistently hovering right around that 0% sensitivity, again, that teeter-totter, that perfect balance, we are not leaving too much cash on the table or making a bet on interest rates. We need to maximize what we can make today and not have to wait for the market to shift and move to continue to be profitable or to increase that profitability. We want to take advantage and structure our balance sheet in a way where we can maximize what we can make today. And that's where you see this hovering right around that 0% mark. We're going to be very stable net interest income over time, no matter what the market decides to throw at us. So that's really the key here, is that balance.
Definitely.
So when looking at profitability, we looked at a couple simple simulation options that we may get to talk about, but that's just kind of scratching the surface on opportunities we may have out there. So what we want to do is we want to ask ourselves, is this enough? What other opportunities are out there? There's things such as we've seen institutions consider, hey, you know what? Commercial lending's never been something that we've done very well. That's not a world that we've been in. Maybe there's some great opportunities out there. Let's look at bringing in maybe a commercial lender, and then maybe we can move some of that lending focus to some higher earning products. Bill, I know you spent a lot of time talking with institutions all over the country. I know there's a lot of discussions out there about different opportunities. What are some of the themes that you're hearing from them?
Yeah, this is one of them, potentially going into commercial lending, or let's say a more commercial role, because also if you're going to do that, right, and whether it's real estate or just other business type loans, also ask for those deposits, right? So these, commercial companies or businesses also have deposits. So ask for that, and that's another way to potentially bring in deposits. There's also some additional things you might be able to do, let's say by bringing in insurance and having some more fee-based businesses, and then potentially the option of potential mergers and acquisitions. So I think those are all additional options that you could take a look at that may be a benefit to the credit union or bank that you have.
Yep. And that's the key here is we need to find what is best for us. Where are our opportunities? The examples here, may not pertain to where our opportunities are. So we need to be able to have those discussions. Reach out to your advisor, talk through these things. Let's try to make a plan on what's going to work best for us. So to kind of recap some of the things that we discussed today is how is liquidity stress impacting our balance sheet? We did an activity here today. Why don't you go, if you're having the same issues, but you're having it in other areas, go through that exercise, start testing those out, see what that impact looks like if that continues for us. Can our NEEF position handle some of the decisions we want to make? What position are we in right now? Do we have a lot of long-term mortgages on our books that we have put on when interest rates kind of hit those record lows? If that's the case, NEEF right now isn't our friend because prepay speeds have slowed down, that cash flow is lengthened out, and that's added some extra NEEF sensitivity to our balance sheet. So if that's the case, then we need to make sure we're planning for that. But maybe it's the opposite. Maybe we've got a lot of room because we were mostly auto lending. So we can take advantage of maybe some more fixed home equities or things of that sort. Now, how will our plan impact profitability long term is really looking at what does our cost look like? How fast is that cost rising for us? And where do we want to price? Where do we want to focus? Looking at all of those possible opportunities and utilizing them to maximize our profit margins. We want to leverage our ALM to help us make these decisions for as we go into these budget planning seasons and making sure that we're utilizing this crystal ball to look in the future and let's test some options and make sure that we're making the right decisions for our institution. So Bill, any last thoughts from your end on anything that we discussed today?
I guess the main thought that I want to leave folks with is use a simulator, do various simulations, because as we know over the last few years, there's been a lot of volatility. Pre-pandemic things were pretty stable. If we go back, we look at inflation, it was around at 2% over the last 10 years. We didn't have a lot of deposit outflows or any of these things, but in the last 4 years, we really had big changes. So I would definitely look at a variety of different options when you're looking at your budget and strategic plan right now, and run those through the models and check them out and try to see what the best one fits. As Heather's been saying, I totally agree, for your institution, because some of the options may not be available to you or too risky for you. So you can look at what you think is best for you. And I would definitely suggest using that online simulator as much as possible to look at those options.
Yeah. Yeah. Definitely taking advantage of the tools that we have access to and having those ongoing conversations with your advisor.
Right.
It's just we want to communicate, do the right things and plan for these obstacles ahead.
Yeah. So definitely call us too and ask us, our opinion. What do we think? What we're seeing? As Heather says, we cover the whole country now, right? So
Yeah.
different parts of the country, we're seeing different things also.
And it varies even within a state. You can be,
Yeah.
more in the city or more rural end, and those are going to look very different from one institution to another. So it's so important to do the right things for us. So we want to thank you guys for joining us today, and we want to open this up to any questions that you may have. And while we're waiting for some of those to roll in, we just want to, again, thank you for attending today. We do have another webinar coming up, which is our EBPA and CDA accounts, and that is going to be presented on September 27th, again at 2 p.m. Eastern time. You'll be able to see links that are going to be sent out to you. You're able to get onto our website and be able to see those as well. And then once we complete today's webinar, you will see a copy of this on our YouTube channel. So please feel free to go back and re-listen to sections if you think this is going to apply and help you make decisions. Take advantage of those tools that are for you, that are there for you as well. We've got lots of great videos that are all on that YouTube channel that you can go and check out. And we do have our upcoming one here in a couple weeks. I don't see any questions that have come in. So we, again, just want to thank everybody for attending today and looking forward to ongoing conversations. We are always here as needed. So thank you and have a fantastic